All right, first of all, are there any questions that came up from yesterday on Form 941 or W-2s? Real quick.
No, ma'am.
Perfect. All right, so we'll get right into it today. So H-2A workers are workers specifically for agricultural, and they come with an H-2A visa. And the IRS has special rules for these workers. It's a temporary agricultural worker program that provides a way for agricultural employers to anticipate a shortage of domestic workers to bring non-immigrant foreign workers to the U.S. to perform agricultural labor or services of a temporary or seasonal nature. So we tend to see a lot of this in Palisade with the peach orchards and the wine grapes. So anyways, they get taxed a little bit different. So foreign agricultural workers that are admitted into the United States on H-2A visas are exempt from federal income tax withholding and Social Security and Medicare on wages paid to them for service in connection with their H-2A visa. So the reporting on these is a little bit different. So if the H-2A worker has provided a U.S. Social Security number, then we need to report wages of $600 or more paid to the worker on Form W-2, and those wages are reported in Box 1. Those wages also need to be reported on Form 943, which is a little different than Form 941. So Form 943 is specific for employers that are in the agricultural industry. And so they file a Form 943, which is an annual return for agricultural employees, instead of filing a Form 941 each quarter. The wages do not get reported on lines 2 and 4 of the Form 943, as they are not subject to Social Security or Medicare. So you want to be a little careful on that. H-2A workers and backup withholding. So employers must withhold 24% backup withholding from an H-2A worker wages if the H-2A worker has not furnished a U.S. Social Security number or an IRS issued individual taxpayer identification number, and the total wages to the worker is at least $600 for the year. Just a heads up, if you don't withhold taxes that were supposed to be withheld, then the employer becomes liable for those taxes. So very important that if you are required to withhold, you do go ahead and withhold that. Reporting of the backup withholding should be reported on Forms 1099 MISC and Form 945, which is the annual return of withhold federal income tax. So again, that is if you're required as the employer to do backup withholding if they do not furnish a Social Security number or an IRS issued individual taxpayer identification number. So the Form W-3 hangs out and goes along with the Forms W-2 for filing each year with the Social Security Administration. So the Form W-3 is basically the reconciliation of all of the Forms W-2 that were filed for the company. If there's 250 Forms W-2 are filed with the SSA, then it must be filed electronically. The due date for the form for the W-3 is January 31st, and you're supposed to include all copies that are the IRS copies, which is copy A of the Forms W-2 with your Form W-3. So it's pretty easy to file those with the SSA online, whether you have a software that's going to create that file for you, or you can just go in and enter them in manually online, and then that would comply with the electronic requirement for filing. And we already talked about how the total amounts on your Form W-3 for the year should equal the amounts from each quarter on your 941s. And so the IRS and the SSA are going to look at those items and make sure that they do in fact match, and if they do not match, then you're going to get a notice. And you're going to have to explain why they don't match or make corrections so that they do match. So just a heads up on that. So for the Form W-3, Box A is a control number, and it is completely optional. The employer may use it to number each transmittal, but it is not required. Box B is the kind of payer / kind of employer, and this box has separate check boxes for each of the types of payers and employers. So, of course, most of your employers are going to be 941s, or your kind of payers, I should say, are going to be 941s, and then your kind of employers, obviously, the most common of this list is going to be none apply. But you could have state or local governments. If you were a third-party sick pay company reporting third-party sick pay, you have that type of option as well. Box C is the total number of statements that you have transmitted with your W-3, so how many W-2s there are. Box D is the establishment number. This, again, is an optional box. Box E is the employer's identification number, and that's the FEIN. So if the client or the employer does not have one at the time, you would enter apply for, but that would be definitely a rare situation because they should have that before they start hiring employees and withholding taxes and paying employees and all that good stuff. Box F is going to be the employer's name. Make sure that that matches what's on the quarterly returns and the annual employment returns. Box G is the employer's address and zip code, and box H is other EINs used in the year. So if the amounts in boxes 2, 3, 5, or 7 do not balance between the Forms W-2 and the 941s, like I said, then there is a form that you can use to explain the difference, and it's called the Schedule D. So hopefully you don't have that situation, but if you do, it can be explained. Boxes 1 through 11 are the totals from the boxes that you entered on the Forms W-2. So like I say, everything has to add up at the end of the day. And we talked about boxes 1 through 11. Well, we talked about all the boxes on the W-2 yesterday, but 1 through 11 are mostly the wages as well as the taxes associated with those wages. And then some additional items like box 10 is dependent care, and box 11 is going to be those non-qualified deferred compensation plans, all those types of things. Interesting, box 9 is reserved for future use, so who knows what they're going to come out with. Box 12 is for deferred compensation. We already talked about some of those box 12 items and those codes that I would be aware of. Again, the main codes that I would look for and be aware of when you're doing your CPP or when you're studying for your CPP exam would be definitely anything associated with deferred compensation, as well as things like HSA or medical insurance. Group term life is also one, and there's maybe some tip codes also that you might want to be aware of. Box 13 is for third-party sick pay, so we would leave that blank if you're not the third-party sick payer. And then box 14 is the income tax withheld by that third-party payer. Box 15 is going to be the state ID number, and so employers are going to use that box to enter their state identification number so that when their Forms W-3 are filed with the state, they can also reconcile to their state account. Boxes 16 through 19 are going to be the state and local wages and taxes. Again, those will be reconciled by your state to make sure that the taxes that you reported for the year match up with the taxes that were reported on the Forms W-2 and W-3 for the year. Reporting rules for agents filing for employers. Agents that have filed with the IRS an approved Form 2678, which is an employer appointment of agent, must meet special rules for W-2 reporting. The IRS and the SSA encourage employers with computer capabilities to use electronic filing for transmitting all of these good forms. The forms are due by January 31st, and the IRS does offer a system called FIRE to also report some of these forms. FIRE is specifically used for reporting 1099s, and it's a pretty good system. But like I say, you can just log on to SSA online, you can grab an account, and you can go ahead and use that account online to file W-2s and W-3s with the SSA, and that makes it pretty easy with those electronic requirements. All right, so if we had a local government employer, and they were withholding only Medicare tax, which one of these forms would they file each quarter? Form 941, Form 943, Form 944, or Form 945. So it is Form 941, the most common form that's filed by most employers when withholding taxes. So that's going to be the 941. Form 943 we talked about earlier, that's going to be your agricultural form. Form 944 is an annual form that can be filed by employers who have less than $1,000 of tax liability for the entire year. And then Form 945 is going to be the annual return of withheld federal income tax. So from non-payroll tax payments. So that one's not going to be applicable in this situation. Obviously, Form 941 is the biggest one that you should have your grasp on. 943 is ag, and Form 944 is an annual return. If you have a super, super, super low liability, you can file Form 944 as long as you have been flagged as a Form 944 filer by the IRS. So even if you have a really low liability, but you are designated as a Form 941 filer by the IRS, you need to continue to file Forms 941. So be a little careful on that. All right, so unemployment tax, super exciting, super fun. FUTA, tax rate and wage base. So FUTA is paid by the employer. There is no employee portion of FUTA. FUTA is the Federal Unemployment Tax Act. Employers pay FUTA tax on their employees' wages at a rate of 6%, and this rate is applied to the first $7,000 of the employee's covered wages in a calendar year. Although the rate for FUTA is actually 6%, most employers do not pay the full 6%. And the reason for that is because employers paying their state unemployment taxes in full and on time are eligible to receive credit against their FUTA tax of up to 5.4%. Any employers receiving the full credit have an effective FUTA rate of 0.6% instead of the full 6%, and they only pay $42 per employee that has received at least $7,000 of covered wages. So that's a huge reduction, but it is contingent on the fact that employers are paying their state unemployment taxes in full and on time. So if those two items do not happen, then the employers are responsible for the full 6% of FUTA tax. 90% or normal credit. The normal credit against FUTA tax liability equals the amount of the employer's required contribution paid in a timely manner into the certified state unemployment insurance fund. So that's what I was talking about the credit that is due back. But those employers have to make sure that they're filing on time and in full to their state unemployment insurance fund in order to be able to receive that credit. Payment must be made for Form 940 by the due date to receive the full normal credit. The due date for the Form 940 is January 31st, just like the Form 941, and the payment due date is also January 31st if you have not paid it throughout the year, and we'll talk a little bit more about that in a little bit. All of the amounts owed must actually be paid. State contributions must be paid by the employer. So most states for unemployment tax are only a liability of the employer. The employee does not pay part of their unemployment insurance. There are some exceptions to that rule. Alaska, New Jersey, and Pennsylvania have an employee portion of state unemployment tax that they have to contribute. So those states are an exception to the rule. And employees are responsible for paying a portion of unemployment in those few states. Like I say, not super common, but it is a thing in those states. The state must have a certified unemployment insurance program. So if you are in a state that for whatever reason did not have a certified unemployment insurance program, then you would not qualify for the credit. All states, as far as I'm aware, have a certified unemployment insurance program, so this is not a problem. There are sometimes where you will receive a notice that says you do owe additional FUTA tax because the IRS does not have a record of your state contributions being made timely and in full. And if that's the case, you can reach out to your state unemployment agency to get proof from them that you did pay in full and on time, and they can send you something that you can include in correspondence to the IRS to get those additional amounts due lifted from your account. Only those unemployment taxes that are required to be paid under state law can be credited against the FUTA liability. So if you have some other tax that is not required by state law, it can't be credited against the FUTA liability. So it's only things that are required by the state law. There are certain things that are exempt from FUTA. I am not going to read this list because you all are capable of reading it on your own, and Manon will, of course, send you a copy of this PowerPoint, so you don't need to hear my lovely voice reading all of this stuff to you. But there are certain things that are exempt. For example, payments made under state workers' compensation law, those are not subject to FUTA. Also, things that are not considered taxable for federal and state, meaning deferred compensation plans, things like that, are not FUTA wages. They are exempt from FUTA. Things like flexible benefit plans, FSAs, any contributions to cafeteria plans, anything like that, that is pre-tax, that is also pre-tax in terms of FUTA. Any death or disability retirement payments, non-cash payments made to agricultural workers are also exempt. There's some exemptions for educational items. Group term life is taxable to the employee if the coverage is over $50,000. It is not taxable, though, for FUTA. So if you work for a federal, state, or local government, you are also exempt from FUTA. They do not have to pay FUTA on that. Work done by full-time students for the school where they attend classes or for an organized camp. So if you're a full-time student and you're working for the school where you attend classes, those wages are also exempt from FUTA. So there's a lot of examples, and you can read through those again. Some of the big ones are also work performed by children who are under a certain age. That's work performed for their parents. So that's one that I had a question on when I took my CPP exam. So just a hint on that. So here's an example, and we're going to go through it. I covered up a few of the answers so that we can talk through it together before you see the answers. So assume there are 20 employees. Each is paid $1,400 per month. At that rate, each employee will have earned $7,000 in 5 months. At the beginning of the second quarter, one of the employees who was on the payroll since January leaves the firm, and 3 new employees are hired at $2,000 per month. For the first 3 quarters, FUTA tax would be calculated as shown below, and the fourth quarter has no wages subject to FUTA tax. So let's look at this a little bit in depth. So if we take each quarter by itself, during first quarter, we had 20 employees, and they were each paid $1,400 a month. So how many taxable wages would we have for FUTA in the first month? I'm sorry, first quarter. I did not mean month. I meant first quarter.
So you just want the taxable wages right now?
The taxable wages, and then we're going to do the tax as well. So if you have the taxable wages, go ahead and multiply by your FUTA rate and get your FUTA tax as well. So if I did my math correctly, and there's really no guarantee on a Thursday at 11:20 in the morning, I got $84,000 in taxable wages. And if I multiply by the 0.6% or 0.006 if you're in decimal land, then I get $504 for FUTA tax. Did anybody else get that?
Yep.
Perfect. 84,000 in wages, 504 for the FUTA tax. So, trick question, not really a trick question, but just this kind of a side note. If we had $504 worth of liability in the first quarter for FUTA tax, when is that tax due?
Is it due January 31st or is it due each quarter?
That's the question, and that's what I'm getting at. So it is over, that is exactly what I wanted you to think about, man. And so it's over $500, and whenever your liability goes over $500, it is due the last day of the month following the quarter. So this was for first quarter. First quarter ends on March 31st, which means that 504, because it's over $500, would be due on April 30th. Correct. If it had been less than 500, you could have not paid it until your liability got over 500. But some employers just choose to pay it each quarter regardless, and some employers choose to save it up. So that was a little extra piece of information. So keep that in mind. If your liability goes over 500, then it has to be deposited by the last day of the month following the end of the quarter. So if we think about second quarter, let's move into, we have our 20 employees for the first quarter, and they're making $1,400 per month. Then we have one of those employees that left at the beginning of the second quarter. One of those employees is no longer with us. And then 3 new employees are hired, but they're hired at a little bit different rate. So they are now making $2,000 per month. And so now we need to figure out our taxable wages and our FUTA tax for the second quarter. So my personal process for this was I took my one employee away, so I no longer have 20 employees making $1,400 a month. I only have 19. Now, those first 20 employees were making $1,400 for the first 3 months, and so they already have $4,200 of their $7,000 in FUTA wages accounted for during the first quarter. So during the second quarter, they would not owe on all of the employer would not owe on all of their wages, but only up until the $7,000 mark. Which, if I did my math correctly, is an extra $53,200 in wages. So that was $1,400 times 19, because we lost one of our 20 employees. And then it was only 2 months worth of wages, because that third month, that extra $1,400 was above and beyond the original the $7,000 that is liable for FUTA. Then we need to talk about our newbies. So we got 3 new employees, and they were hired at $2,000 per month. So if we do our $2,000 times 3 months times 2 employees, we get an extra $12,000. Oh, it was 3 employees. Sorry, I can't read. 3 employees times $2,000 a month times 3 months. So for those last 3 employees, they have worked for 3 months at $2,000 a month, and so they each have $6,000 in taxable wages for FUTA, which means they still have a little bit left over that we're going to have to deal with in third quarter. But at this point, if we add up our 2 amounts of taxable wages, we get a total of $71,200, and again multiply by our FUTA tax rate of 0.6% or 0.006 if you are in decimal land, and you get $427.20. So Manon, is that one due at the end of the second quarter, or can I wait to pay that one?
You can wait to pay that one.
I can wait to pay that one because it's under $500. Okay. All right, so now let's talk about third quarter really quickly. So third quarter, let's first talk about our first 19 employees. Have they reached their FUTA limit so far?
Yes.
Yes, so we don't have to worry about their wages anymore. The only ones we have to worry about is those last 3 employees that are making $2,000 a month. They had $6,000 each in taxable wages for FUTA in second quarter, which means there's an extra $1,000 left over for third quarter that we have to take into account. So $3,000 total, 1,000 times 3 employees, and we get an extra $18 in the third quarter that's owed for FUTA. Now, we had $427 in liability during second quarter, and we're adding $18 now during third quarter. Do I have to pay it at the end of third quarter?
No.
Correct. I do not, because it's still not over 500. So I can add those two together and I do not have to pay it, but you can. It doesn't hurt anything. So FUTA is kind of an interesting beast, and if your state that you're in had to borrow money from the federal government to help with their own unemployment claims, then they no longer get to claim the FUTA credit and they have to pay an additional amount to FUTA. So we're changing our scenario a little bit. We're assuming in December you learn that the federal tax credit that each employer normally gets of 5.4 is reduced by 0.6% for employees in your state, which means the effective FUTA tax rate is now 1.2% instead of the normal 0.6%. So we would take our totals and we would look at all of the wages for the year, which was $158,200, and we're now going to multiply by our corrected FUTA rate of 1.2% or 0.012, and we get a total tax rate of, a total tax due of $1,898.40. We paid $504 of it in April because it was due after the first quarter, which means that now, due by January 31st, is the remaining amount of $1,394.40. To everyone who's not looking at the chat, Rebecca just chimed in and said that calculation was specifically on her CPP exam. So I do not remember one of those on mine, but obviously she had one on hers, so it's fair game. So just keep in mind that the FUTA tax can change based off of whether or not you are in a FUTA credit reduction state, is what they call them. And that happens when a state has to borrow money from the federal government to help pay their own unemployment claims. Questions on that?
You still also owe the $427.20 and the $18, right?
Correct, which was included in the calculation.
Okay.
So, yeah, that was part of, because this was the full FUTA tax, which included that original $427 and $18. Great question.
Okay.
So the only amount we did pay was the $504.
Okay, and so the $427.20 and the $18, since you can wait to pay it, it's also due January 31st.
Correct. Yes.
Okay. Thanks.
Yep. Yeah. Okay, so we've talked a lot about this, so you guys should already be pros. FUTA is an employer tax, not an employee tax. The rate is 6%, and the wage base is $7,000. There is a credit of 5.4% as long as you, as the employer, are paying your state unemployment tax in full and on time. So that makes the effective tax rate of 0.6% instead of 6%. And that's only if you're not in a FUTA reduction state, which at least at the end of last year, I don't think there was any FUTA reduction states still left over. California had one, or was a FUTA reduction state for a really long time, but I think they finally paid it off. So anyways, we hope that COVID will not wreck that for everybody. So again, we've already talked about the due dates for FUTA. If your liability goes over $500, you have to pay it the last day of the month. It's due the last day of the month following the end of the quarter. But if your liability does not go over 500, then it is not due. You can pay it, but it is not actually due until that liability reaches 500 or more. So the 940 is the form that goes along with your FUTA. It is an annual form that is reported to tell the IRS how much you paid in wages and how much of those wages were exempt from and then in turn eligible for FUTA tax. We've already discussed the fact that FUTA is an employer tax, not an employee tax, so you should not collect it from the employee's wages. It's due on the first $7,000 of taxable wages to each employee during a calendar year. State and local governments are exempt from FUTA and do not have to file Form 940. The due date for the filing for Form 940 is January 31st. However, the deposits have to be made as you go if they're over 500. So just keep that in mind. All right, here's a picture of the 940. Adorable. One thing to take note of that I learned the hard way several years ago is that there's a 940 for each year. So a 941 is, you do a corrected 941, but it can be for a different year. Like you use one form for a corrected 941. But if you're doing a corrected FUTA return or 940, make sure you grab the right year of form. And like I say, I learned that the hard way a few years ago. So just quickly. So completing Form 940, line 1 is going to be your unemployment taxes where you're paying them, whether you're in one state or if you are a multi-state, then you're going to have to complete another form that goes along with your 940 to tell the IRS what states you're in. Line 1B, when you are paying state unemployment taxes, that's when you're going to check that box. And then if you check the box on 1B, you are required to complete Schedule A, which tells the IRS which states you were in. And that's what they're going to look at to see if you qualify for the credit. If you're in a state where there's a credit reduction, like we had already talked about, then you will complete this checkbox on line 2, and you'll also have to complete Schedule A. Line 3 is going to be all of your payments to all of your employees. It's all of your payments, so even if it's above the wage base. Line 4 talks about payments that are exempt from FUTA tax, so we already talked about some of those: retirement plans, group term life, fringe benefits, dependent care based off of an FSA plan, things like that. So all of those items are going to be laid out in line 4, the section on the 940, and it has little check boxes that you would check to say why these payments are exempt from FUTA. Line 5 is a calculation of the total payments made to each employee in excess of $7,000. So again, FUTA is only taxable for the first $7,000 for each employee that's paid in the year. So anything in excess of that for each employee goes on that line. Line 6 is just math. We're going to add lines 4 and 5. Line 7 is total taxable FUTA wages, and we're going to do, again, math. Subtract line 6 from line 3 and enter that amount in line 7. Then we're going to multiply by 0.6% or 0.006 if you're in decimal land, and then you're going to enter that amount in line 8. That is your total FUTA tax due before any other adjustments. Line 9, if all the FUTA wages were exempt from state unemployment tax, then you're going to have to add in some additional tax. And that, again, goes back to you're only eligible for the credit if you paid all of your unemployment tax timely and in full. So if all of your wages were exempt from state unemployment tax, then you have to pay the full amount on those wages. Line 10, if some of them were exempt, then you have to complete the worksheet found in the instructions, which the worksheet walks you through whether or not you paid enough in to be able to qualify for the credit. Line 11, if credit reduction applies, then you're going to copy the amount from Schedule A. So that Schedule A is that thing that you fill out if you're in multi-states or if you're in a credit reduction state. Line 12, we're going to do math, and we're going to find our total FUTA amount after all of these adjustments are applied. Line 13 is the total amount that's been deposited for the year. So if you had made payments along the way throughout the year, whether it was because those liabilities were over 500 or because you just want to pay it each quarter so you make sure it's not late, we're going to put that on line 13. Line 14 is a balance due. So just do math. and you will go ahead and pay that by the end of January. If there's an overpayment, then you would subtract line 13 from line 12 and check the appropriate box to tell whether you wanted a refund or if the credit will be applied to next year. Line 16, report FUTA tax liability for each quarter. Do not enter deposits made for the quarter. So this is where you're going to basically tell the IRS whether or not you had over $500 each quarter. And if you had over $500 in any quarter, or if you add them together and they become over 500, then the IRS is going to have expected you to make a payment. So that's where you're going to line out each quarter and how much liability you had. And then line 17, add them all up, and it better be equal to line 12. If it's not, then we have bigger problems. 1099s. 1099s are a thorn in my side right now because the IRS decided to change them, which is annoying. 1099s used to be basically one form. There was a 1099, what they called MISC, and it was pretty much all-encompassing for payments paid to non-employees. And the IRS decided to split that into two forms. They now have a 1099 MISC, and they now have a 1099 NEC, which stands for non-employee compensation. That came about in 2020. Well, it was effective in 2020. Came about before that, I suppose. But it was effective in 2020, which on top of all of the other things that happened in 2020 was fun to deal with. So payments on 1099s that need to be reported are payments they have to be more than $600. If they were payments to healthcare providers, royalty payments, payments to attorneys, other payments, including if an employee dies during the year, then their wages have to be reported on a 1099 as well as a W-2. Also, backup withholding gets reported on 1099 MISC, and non-qualified deferred compensation gets reported on 1099 MISC. 1099 NEC, which is the new one. This is 1099 non-employee compensation. This used to be box 7 on form 1099 MISC. And I don't know, I'd have to ask Rebecca and Katie, I guess she's on the phone too, if you guys remember having many 1099 questions on your CPP.
I did not.
You did not. I don't remember having, I maybe had one about what form you report non-employee compensation on, but it wasn't anything real specific. So,
right.
But that doesn't mean it's not important.
And since they've split out the two forms, it may be something that they would want to say which form would you use for non-employee compensation, or, just to make sure people understand the difference.
Very good point.
And what I would add is I do think that I had a couple, maybe only one or two questions that in the calculation, it was asking how to calculate taxes. And one of them was really a 1099 and didn't need taxes. But my test was a very long time ago. So
don't you hate those trick questions?
They do, and they like to give you more information. Yeah, and they like to give you more information than you need. So they make you think that you need to calculate taxes when in fact you may not. So yes, good point. I didn't think about that one. So the NEC, like I said, is the new employee, non-employee compensation form that came out in 2020. And what used to be reported in box 7 of the form 1099 MISC is now reported on a separate form, form 1099 NEC. So the rules are kind of the same. The $600 threshold is still the same. It's just that we don't report, it's no longer reported on the MISC. It's reported in this more specific form. Box 1 is for the non-employee compensation. Box 4 is for any federal tax withheld from that non-employee compensation or backup withholding as we know it. Box 5 and 7 is for state income tax reporting, and boxes 2 and 3 are reserved, but there's nothing in them at this point. Form 1099 NEC also includes checkboxes to indicate that the payer is reporting payments subject to the Foreign Account Tax Compliance Act, and the IRS notified the payer twice within 3 calendar years, the payee provided an incorrect taxpayer identification number. So sometimes we get these notices that say that the taxpayer identification number doesn't match the name provided. And so you as the employer need to make sure that you are following up on that and making sure that your 1099 people or your 1099 companies are giving you accurate information on a Form W-9. Filing of Forms 1099 is the same as Forms W-2 in most cases, meaning the deadline is January 31st of the year after the payments were made. And there are multiple copies similar to a W-2. So you have a copy that's actually sent to the person who's receiving it and the person who was paid. And then you also have copies that get sent to the IRS as well as the states. There are some additional 1099 forms that are a little less common. There's the 1099-R, which is to report distributions from pensions, annuities, or retirement plans from profit sharing plans, IRAs, things like that. The 1096 is the reconciliation report that goes along with your 1099. So it's similar to the W-3 for W-2s. It's the reconciliation report that goes along with the 1099s. So other annual returns, the 944 we touched on a little bit. It's the annual federal tax return, and it's designed for little teeny tiny employers whose annual liability for employment taxes is $1,000 or less. This is uncommon for a lot of employers just because $1,000 or less in annual liability is pretty small. But again, you want to make sure that if you're filing Form 944, it is authorized by the IRS that you're filing Forms 944. Because even if you're, have been in the past a Form 941 filer, you can't just drop down to a 944 filer because you don't have very much tax liability. So you want to be careful of that. 945, again, we've talked about this in a little bit. This is the annual return of withheld federal income tax that is associated with non-payroll payments. So if you're withholding tax from pensions, retirement, gambling winnings, or any payment subject to backup withholding, this form must be filed. Schedule D is, we talked about it a little bit, to report discrepancies caused by any acquisitions, mergers, or consolidations between companies. If there is a discrepancy between the amounts reported on your Forms W-2 and your Forms 941 that were required to be filed for the year as a result of that acquisition or merger or consolidation. So that Schedule D is important if you have anything like that. 943 we also talked about, that's the agricultural return, and it is an annual form. You don't have to file it each quarter, but it is only applicable if you are an agricultural filer with the IRS. So you want to make sure that you file that, but only if you are an agricultural employer. And if you're not an agricultural employer, you better be filing a 941. Form 1042 is the annual withholding tax return for U.S. source income of foreign persons. So any amounts paid to and taxes withheld from non-wage compensation and amounts exempt from the tax treaty paid to non-resident aliens must be reported on this Form 1042. I do think I had a question on that one. And I think I had a question on the due date of this one as well. So the due date of the Form 1042 is March 15th. So I would maybe make a note of that one. All right. Oh, apparently you get the answer to that one because I clicked too fast. Sorry, guys. Pops quiz, Schedule R, which goes along with Form 941, is used for what? Good job. It's A, to allocate the aggregate information reported on 941 by an agent to each client. So if you had if you had a combined 941 that you would needed to add to show which amounts went to each client, then you would use Schedule R. Okay. It's 9:45.
Yay, Melissa.
Yay. Are you tired of listening to me talk yet? Tired of talking.
I could listen to you all day.
Oh, you're so sweet. All right, guys, same time, same place tomorrow.
Great. Thank you.
Okay, bye.
Good. Thanks, guys. Talk to you tomorrow.
Thank you.